You guys know that there are certain differences between future contract and forward contract. Both future and forward contracts are involving the agreement to buy and sell asset at a future date. However, when one looks at their technical details, the two contracts function differently. A future contract has standardized terms and is traded on an exchange where prices are settled on a daily basis until the end of the contract. A forward contract is a private agreement between the buyer and seller to exchange the underlying asset. Settlement date, quality, quantity, rate, and the asset are fixed in the forward contract. On the settlement date, the contract is settled by physical delivery of asset in consideration for cash. A forward contract is traded over the counter (OTC) where the terms of the contract can be customized as per need of the parties concerned. The market for forward contracts is often hard to predict. That's because the agreements and their details are generally kept between the buyer and seller and are not made public. Because they are private agreements, there is a high counterparty risk. This means there may be a chance that one party will default. Regardless of the two contracts sounding similar, the two contracts have distinguished aspects. First, regulation. A future contract operates under regulations from the mandate authorities, while forward contracts have no exchange regulations. Second, standardization. A future contract is usually standardized, while a forward contract is not standardized. That means that with a future contract, you can look at the historical trends of the market and identify trading opportunities. For the non-standardized contract, the contract can be customized with respect to the size, time to maturity, and the underlying asset. Third, default. In the case of a forward contract, there are high chances of default by a party as the agreement is private in nature, unlike a future contract where clearinghouses are involved that guarantee the transaction, so the possibility of default is almost nil. Fourth, settlement of contracts. The settlement of deals in forward contracts occurs at the end of the signed part. On the other hand, futures contracts are usually on a daily basis. This means that all the daily changes are settled by the day until the contract comes to an end. Financial futures are used by companies to lock in the value of asset or liability or to guarantee the value of receipt and payment. When issuing bond futures, sell some of it at the current price, thereby locking in current yield. Next, buy bond futures contract to hedge the risk of interest rate falling if it has a fixed interest rate loan. Short interest rate futures has a floating rate loan. It can use to fund any increase in the interest rate payable, but will have to pay over any interest saved if market rates fall. For stock index futures, during a takeover, the predator company can buy stock index futures to hedge the risk of rising in the target company's share price. Currency futures could be used to fix the value of foreign receipts or payments.